Bank of England announced today that the UK interest rates will remain at 0.5%, while rates remaining at this level. Joining me on the line to discuss is Jack Meaning from NIESR. So Jack, economic growth in the UK has been described as lacklustre. Low inflation and falling house prices has pushed back expectations of when the bank will start to raise rates. Is the UK facing a slowdown?
So it's true to say that the 0.3% we had for Q1 was below the expectations of most forecasters. But actually, if you think about it in an annual context, we've still had reasonably robust growth year on year. And we'd expect the quarter-to-quarter numbers to jump around a little bit. So at NIESR, along with most other forecasters, we're envisaging that this is going to be a slight temporary slowdown. And actually, we have a monthly GDP series that we estimate ourselves, and that already shows signs of a pickup. So we're reasonably confident that this is just a temporary kind of fluctuation as opposed to a sign of a more serious slowing down. So we're expecting growth to pick up back to where it was kind of at the end of last year and finish this year around 2.5% for 2015 as a whole. With the housing market kind of slowing down, that's also the same kind of thing. Going into the election, we saw kind of the UK property market slow down maybe a bit more than we were thinking it would. But this side of the election has already been quite strong signs that, especially in London, the house market has started to pick up again. So that's going to be adding to growth over the rest of this year. The real key for growth, though, more sustainably, and whether we do see this kind of lackluster trend or whether we see it be robust going forwards, is whether we can see a pickup in productivity. And if we see that, then we'll expect growth to kind of be relatively robust over the next few years. If we don't see that, then we might start to have problems. But I mean, people's guess on that is, my guess is as good as anyone else's. I think with that, we're all hoping productivity will pick up, and we haven't quite seen it yet.
There was expectations of the UK raising rates after the elections. The previous 6 years have seen rates unchanged. How do you expect markets to react with the possibility that rates may remain unchanged throughout 2016?
So if you look at where market expectations of rate rises are, the general kind of consensus is that they'll go up towards the middle of next year. So I think the interest rate curves are priced in around July next year. Our personal view at NIESR is that it's going to be a little bit earlier than that, so we're looking more like February. So in earnest, we're not really expecting it to last all the way through 2016. That said, if things take a downturn in the Eurozone, or if this low inflation environment we've got at the moment starts to persist, then it may push back. But at the moment, markets as well as us are thinking, towards the middle of next year is probably the latest that interest rates will start to go up. For market expectations and how they're going to react, I mean, the key there is communication from the central bank. If they communicate what they're going to do clearly, and markets understand that, market reaction should be relatively subdued because the bank aren't giving them any surprises. If we see bad communication or markets are surprised in any way, then actually that's going to add quite a bit of volatility into markets, and we'd expect to see some kind of swings in prices and rates off the back of that.
Sharply declining oil prices have led to a fresh fall in inflation, reaching minus 0.1%. With inflation set to fall further mid-June, how could lowering inflation correlate with the interest rates rising?
In terms of the impact from that low inflation and to what extent rates need to react to that, the key kind of thing to distinguish there is which are the temporary factors that rates can't really do much about, and which are the more kind of long-lived ones that you'd expect the Bank of England to react to. So you mentioned the oil price. That's almost certainly a temporary factor as far as we can tell. We've already seen oil prices come back up since the beginning of the year. So the bank probably won't move interest rates in reaction to that. Very similarly, the exchange rate, the appreciation of sterling, that will cause inflation to be low over the next year or so, but then that will drop out of the figures, and so the bank shouldn't necessarily be reacting to that by moving interest rates. The important element in the medium term is the amount of spare capacity, so how much slack there is in the UK economy, and the Bank of England's estimates on that are not very much is left. So that would mean that we'd expect to start seeing increase in inflationary pressure as that spare capacity is used up over the next year or so, and that is what is really causing them to think about when they're going to start putting rates up. The only time they really need to start thinking about whether they're going to keep rates lower for longer or cutting rates, one element is the Eurozone. If that starts to go kind of go negative from where it is now and escalate there. The second thing is whether people start to change their inflation expectations. So if this low inflation we've got at the moment, if that causes people to put off spending, and then that causes prices to fall even further, then you can get into a deflationary cycle, and then they'd need to react by moving interest rates. But all the signs at the moment is that's not the case. People are still going out spending, and in fact, they're enjoying the fact that prices are keeping it cheap for them to get more bang for their buck. So at the moment, we're not really kind of envisaging that there's going to be much of a reaction on the downside on interest rate rises.
That's great. Thank you for speaking to us today. For further updates, do check out the Dukoscopy website. Goodbye for now.